Hi, welcome back to video 4 in our tax reduction series. As we go back to our chart of the taxes that really hurt, we're going to talk about, in this section, tax on our IRAs. I normally ask the question again when I do my live programs, what does IRA stand for? And a lot of folks will say, oh, that's individual retirement account. The true meaning of IRA, it actually is an internal revenue account. Some people don't get it, but the amount of tax that's due on these, it really is basically an internal revenue account. Before we go too far, I want to ask the question, or we should ask the question to the IRS. So what does the IRS say about your IRA? It's theirs. If you take the THE and the IRS and bring it together, you'll see IRAs are really I'm going to call it almost a tax bomb. It's important to understand that there's a huge amount of tax that's due on it. It affects your eligibility for means testing for Medicare Part B and D. It affects your IRMA, as well as affecting tax on the Social Security itself. So there's so much in there that these IRAs make a huge difference that we're going to review some of the ways we can kind of reduce those taxes. There are three important items that I want to review. One is reducing taxes while you're alive. Delaying taxes while you're alive. And last on the list is keeping the tax man away after you're gone. Let's review out of the three, reducing taxes while there are 5 superior methods that we can use to help reduce taxes while you're alive. 1 is a Roth conversion. 2 is a strategic IRA rollout. Number 3 is an IRA tax rescue. Number 4 is IRA arbitrage. Number 5 is charitable planning. What we're going to do for the sake of this video, we're going to review 2 of the 5, Roth conversion and charitable planning, the strategic IRA rollout, as well as the tax rescue and tax arbitrage. A little bit more complicated to review on a few set of slides, but if you have any questions about ways to minimize the taxes while you're alive and get the growth outside of the tax problem or outside of the tax IRA, then just let me know by email and we'll try and be a little bit more specific with that help. Has anyone heard of Roth IRAs? You know, some people are still not sure, but Roth IRAs are pretty straightforward. Understand this, there is no extra tax that's due to convert. People think you pay more tax to convert. The answer is no, there is no extra tax. Income, when you take it out, is not subject to, one is obviously tax, we know that, but it's also not subject to the Social Security tax penalty. It has no effect on your Medicare Part B and D cost, and if you're in New Jersey, money coming out of the Roth has no effect for the Senior Freeze program, which is for property tax relief, but that, again, that's only in New Jersey. When we look at qualified withdrawals, we remember they're all tax-free, but the important thing is that it becomes a tax-free legacy to multiple generations. Doing a Roth conversion is pretty simple. When you think of an IRA, you think of it as a giant pot of money or a bucket of money. It's a highly, highly taxed asset. There's nothing favorable about it at all. It affects, I said, the Social Security situation, IRMA for your B and D of Medicare. There is very, very little benefit to having the IRA as far as taxes are concerned. What the Roth does is it takes the big tax bomb, if you want to call it, and it brings it over to an area, and that's why I see the green bucket's a little bit bigger. It now allows that growth to continue on a tax-deferred, or I'm sorry, a tax-deferred basis, but it's important that when you take the money out, it's a tax-free basis. When you're looking at a Roth, there's really a huge, there are massive benefits to it. One, as you look at it prior to the Roth, any distributions coming out of that IRA, it's 100% taxed, plus any of the growth in that IRA as you go through your retirement years is also taxed. Once you do the conversion, taxable distributions that you take after conversion, there's zero tax due on it. And any growth in that is also taxed at zero. There's no tax on it in the growth. So as that account compounds, over maybe a 15, 20, or 30-year retirement, any of that growth is tax-free. What we try to do is explain how the benefits of the Roth work. Number one, I look at the Roth, and I kind of coined the term, it's an old age Roth. Some folks were looking up on the internet for an old age Roth, couldn't find it. But I look at it as a Roth, it's kind of an old age fund. What happens if you get to an older age and you need some help taking care of, they call it activities of daily living, and you need some help, it will double your income to help pay for those costs. One of the benefits of a Roth IRA is there is no required minimum distributions. You don't have to take the money out at 70.5 like you do on a traditional IRA. Now that's great for folks that may not need the money, at least not at 70.5, so that money can kind of stay in there and continue to grow. All withdrawals are tax-free. When you do take the money out, there's no increase or no effect on your Medicare costs, which is important. And it also may help to reduce the tax on Social Security. The best part about it is it creates a tax-free legacy. So if this money is left to children or grandchildren, they can inherit the money on an income tax-free basis. But the nice thing is as that money grows over their life expectancy, all that growth is tax-free as well. A lot of folks sometimes don't grasp the overall concept, and it's simple. If you had a choice of paying tax on the seeds for a crop, let's say you're going to plant corn, and they'll say to you, okay, the tax on the seed is this dollar amount. Or would you rather we give you the seed for free with no tax? But you're going to pay tax on the big crop that you get from this planting. So when I use the analogy, the tax the seed or the crop, it makes way more sense to pay tax on a smaller amount, which is the seed, than it would be to pay the tax on the bigger amount, which is your harvest or the full crop. When you look at charitable planning with IRAs, it's very important. You can get a charitable trust that will provide you with a lifetime income for you and or a spouse. You can get a large tax deduction that you can use to convert an IRA to a Roth for free. And you have a tax-free inheritance for family members. So that's the big, the big item there. If you're leaving an asset, as we're going to learn a little bit, when you leave assets, IRA assets to family, the government really comes in and takes a huge hit or takes a huge amount out of there. By leaving it within a Roth concept, that money is now protected, and all the money as well as the growth is tax-free. We're going to review the three important items: reducing tax while you're alive, delaying the taxes while you're alive, and keeping the tax away after your death. So we're going to look at the second one, delaying taxes while you're alive. Now, a lot of folks may or may not have heard of it. It's called a QLAC, and a QLAC is a Qualified Longevity Annuity Contract. Now, it's important because this is an income contract that protects against the risk of outliving your retirement savings by providing an income security later in life. So a lot of folks will always say, I'm a little concerned if I run out of money, if I live too long. A QLAC is a great way to take care or alleviate that problem. Now, what's important is a QLAC must be purchased within a traditional IRA, a 401k, 403b. it's important to understand you just can't go to a bank or to a broker and say, I want to buy a QLAC. You can only buy the QLAC inside of an IRA. It has to be IRA funds that come out to purchase this thing. Now, what's nice about it, payments must begin by the month following the month that you turn age 85. So the concept there is that your normal IRAs have a distribution forced out at 70 and a half. A lot of folks will say, I don't need it at 70 and a half, but I may need it later on. And if I take it out sooner, what do I do with it? Then you have to put it in an account. You get taxed on it again as you get your 1099. So the QLAC was designed that you could delay payments up to age 85, but it's important you can start sooner. So if you get you want to start it at 78 or 79 or whatever age, you can start it sooner. You don't have to be at 85, but at 85, it's forced to come out. The nice thing about a QLAC overall is that the value that's in the QLAC is excluded from your retirement account balance. So what it says is this: if you have money in a QLAC, those dollars are not counted for what you have to take out or your required distributions on your IRA. So basically it puts it almost in an island where that money is not counted. So that's a nice thing, because what it'll do at age 70 and a half, it'll give you less of a distribution to come out of your IRA, so less money is coming out. There are some stipulations. One is the limit to purchasing a QLAC has to be this: it's either 25% of the value of your IRA or no more than $125,000. So what that's saying is this: if you have a $100,000 IRA, you can't put the whole $100,000 in a QLAC. The most you can do in this case is $25,000. So that's important. That's kind of a rule. The most total you can put in there is basically $125,000. Now, the nice thing about it is this: they're less expensive than traditional income products. And as a result of that, they'll generate a much higher income payout. So if you wait until, let's say, 80, and you start taking the money out, the income that's coming out of there is way higher than it would be with a lot of other traditional products. Now, as you use a QLAC, you can be a little creative and say this: QLACs can also allow you to claim Social Security benefits earlier. Why would I want to take my benefits earlier? Well, obviously, you're getting the money sooner. It also helps with your Medicare hold harmless clause if you're turning 65. But the important thing here is that the QLAC will allow or will give you a supplement to the money that you're forsaking by taking the Social Security benefit earlier. Very important. Now, the other thing that's important, if you take Social Security early, the amount that must be withdrawn from your IRA is going to be less because you have other income. You've got Social Security income. So that means the less that's coming out of the IRA will be smaller. And the benefit to that is what? Simple. If you're taking less out, then more of that balance could continue to grow. And the higher the balance, the better in the long run. The last topic on these three important topics will be keeping the tax man away after you're gone. Great cartoon. I love it. They got a couple sitting on a sofa and they ask, what's a 7-letter word for sound financial planning? And the husband answers, inherit. We're going to talk about something called a stretch. It's a stretch IRA. The concept is pretty straightforward. You have to understand what the tax man doesn't get while you're alive, he gets after you're gone. Taxes that you're passing on an IRA can exceed 34% and up to 72%. So you can possibly lose 1/3 to 3/4 of an IRA lost to taxes. Now, when I do the live programs, a lot of folks will say, that can't be. How's the government going to take 75% of your IRA? And I go, well, number one, you don't understand the tax code. and you don't understand how estate taxes affect you. And they'll go, wait a minute. But we'll talk about the estate taxes in a little bit. So it's important to understand that a huge amount of IRA dollars will be lost to taxes. Number 3 or 4 on the list, you lost tax-deferred growth of that money. If you passed away sooner than later, all the years that money could have grown, tax-deferred, is lost. You want to be able to give your family choices. Now, one of the things that is so important is that because of the tax nature of these IRAs, you want to give your family choices of how to take that money, maybe disclaim. We'll talk about that in a few seconds. But you have to have choices. It can't be that here's the money, sorry, it's going to be hit, I'm losing 72% and I have no choices. But it's important to understand it doesn't happen automatically. You have to plan and have to know what to do. The concept behind a stretch IRA is fairly straightforward. It really revolves the longer you can stretch an IRA, the more your account will grow and the larger the distributions that come out of that account. As the account continues to grow, then more dollars become available to distribute, and that really helps increase long-term benefits to family. So the concept is really straightforward. You want to stretch that IRA as long as you can. In some cases, if you have grandchildren, you can stretch it over their life expectancy. So the longer that IRA can stretch, the longer that money will last and the more dollars that come out because it's continuing to grow. The problem is 98% of IRAs are not set up properly. People ask the question, why? Well, we're going to go over that in a second, but most of the IRAs, most IRAs are going to be lost to taxes. In other words, the government is not benevolent, and they are fair, but they're not benevolent. And here's the problem. If you have an IRA and you don't plan well, the IRS is going to get a huge tax gift at your passing. So you have to understand the IRS has the rules, but they're not going out and knocking on your door telling you here's what you can do to delay the amount of money we get. So you have to understand most IRAs are going to be lost to taxes. The years of tax-deferred growth will be lost forever, as well as many options will be lost because you're not giving your family choices. One of the key documents in a IRA, a 401k, 403b, and I use the terms interchangeably sometimes, or refer to just as an IRA, you got to have something called a retirement asset will. It's called an RAW. Sometimes they refer to it as an SBF, which is a specialized beneficiary form. It goes by a lot of different names, but it's a document that really controls how the IRA is handled. Now, there's 4 items that are very, very critical. 1, it must include a clear set of directions. This document must allow for flexibility, control, and disclaimers. Now, what I refer to a disclaimer is this. If my wife and I pass away and we leave IRA to our 4 children, and one of my children is having financial problems, is going through a divorce or a business problem. If they inherit dad's IRA, dad and mom's IRA, the federal government doesn't protect an inherited IRA from creditors, so that money could be lost. So my children need to be able to disclaim. They need the right to say, I'm not going to take the money, I'm going to disclaim this money on behalf of my children. So it's very, very important to have all those items in there. Now, it has to be signed by your administrator. What an administrator is, basically, it's the bank or brokerage that has your IRA that's in their possession. And the document must be in your possession. In other words, that document can't be on file at the bank or the brokerage or it's somewhere. It has to be in your possession. Very important. You must have a roadmap. And that's going to show you what to do and when to do it while you're alive, as well as after your passing. IRS rules are probably one of the most complex ever written. And a lot of times you have experts that are somewhat baffled by the rules, and unfortunately, the tax courts and the IRS keep changing the rules and making it kind of difficult. So number one, you have to know the rules. It goes without saying. Now you have to know how to apply them and how to apply them correctly to your situation. This is why when we talk about knowing the rules and how to apply them, the roadmap is really, really critical to help navigate the mess. I'm going to do a quick test. You know, a lot of folks will have an IRA. They're fairly common. They've been around since the, I guess, 1974. So let's do a quick test. You're gone, and the children or someone, family. Now, when I refer to family, I'm referring to non-spouse beneficiaries. Spousal beneficiaries are really treated almost like the owner themselves. There really is almost no difference. You don't have to make changes, you don't have to do conversions, you don't have to do anything. You can kind of leave the IRA alone, roll it into yours. There's so many different flexibility with spousal benefits. When I talk about passing to family, I'm referring to non-spousal beneficiaries. This could be kids, grandkids, nieces, nephew, brother, sister, any kind of family member. So let's ask these questions. If a beneficiary inherits the money, do they have to take all the money out? Can they roll it to their own IRA? If they're under 59 and a half and they inherit the money, could they put it into their own IRA? Can they postpone taking the money out until 70 and a half? Let's say they're only 50. And they say, well, I'm not going to take the money out. Can they wait until 70 and a half? Do they use the same withdrawal chart that you or I would use if it's our own IRA? Can they disclaim and give it to their kids? And if they take the money out before 59 and a half, will there be a 10% penalty? Now, the answer to all those questions are no. IRAs, when passed to family members, fall under an entire different set of laws that you or I would be familiar with. Now, unfortunately, most folks die once, and children inherit an IRA just once. So there's not a lot of experience out there with inheriting these accounts, but they're very critical. If you miss any of these options, then that's when the IRA is really crushed with taxes. So what's the big deal? People say to me, Joe, so what? The government's going to get their share anyway. But let's take a look at this example, and we have an IRA. There's approximately $100,000 in it, and the owner passes away and leaves two children as their beneficiaries. We're going to see here that the IRS is going to get at least a third, and the two children will get a third and a third. They'll split the remaining. Now, it's at least a third the IRS is getting. It could be more, usually is, but for the sake of this comparison, I just want to show you that you have two children. You pass away with an IRA of about $100,000, and that's going to be a third, a third, and a third. You actually have three children. Now, what's important is if you have more than $100,000 in an IRA, if you have 50 or you have 200,000, whatever the number may be, we just kind of multiply. So if you have $200,000 in an IRA, then it's double the amount. If you have less, then it's obviously half. Using the same scenario, but with proper planning and a roadmap so everyone knows what to do and when to do it, you can increase the benefits on that IRA 5 to 7 times. So it could be on an IRA that's $100,000. That IRA can distribute anywhere from $500,000 to $700,000 in income to beneficiaries. Now that's a huge number. If you have a $200,000 IRA, it's possible that you're talking close to $1.5 million. So we're not talking about a few pennies, nickels and dimes here and there. We're talking about a large amount of money if it's playing well. Now the problem is, not all companies will do that management for you. What I found is most advisors fail to tell you, or they just fail, period, because they're afraid to lose your account and the commissions that go with it. So let's say, for example, I don't want to bring a specific company name up, but XYZ Brokerage, They may not do a stretch IRA. They don't want to take the responsibility to manage the money over multiple generations. So they were not going to tell you, hey, we don't do that, or my company doesn't do that. Most often they'll pay a lip service to you. And it's unfortunate because, oh, yeah, we do that. Don't worry about it. Everything is good. And you may trust the broker or advisor. Okay, fine. Everything's good. And you kind of put it away and don't think about it again. The problem is after you're gone, no one knows what was said. And your family ultimately pays the penalty for that. 98% of all your estate planning attorneys or estate planners really neglect this as well. So it's really a quite prolific problem where you have a lot of people that out there are not setting their IRAs up properly. You can lose a lot more of your IRA to taxes, and a lot of folks don't realize that New Jersey has an estate tax, and it starts at 37% and applies to estates over $675,000. This includes your home, when they add all your home, your IRA, all your assets. Now, we have to be careful because we talked about it, is that a lot of folks may forget that New Jersey does not follow the federal limits. The federal government says you can, I think it's $5.5 million. You can pass a lot from one generation to the next. New Jersey does not follow that. New Jersey has their own set of numbers, and the numbers are, it starts at $675,000. Now, what you have to realize is that not only is the IRA going to be subject to estate taxes, it's ESTATE, it's also going to be subject to income taxes. It's both. That's why we talked about that red bucket. It's a really massively heavily taxed bucket rather. In this case, 35% income tax plus 37% estate tax. So you have, in this particular case, could be 72% of the IRA is lost to taxes. Regardless of what you can pass, and I stress this because people get confused, regardless of what you think, the IRA is always going to be subject to income taxes. You have to remember, IRA is going to be subject to two levels, one or three. One is the estate tax. If you happen to have more than $5.5 million, the local estate tax in New Jersey, which could be anything over $675, that includes everything. But then again, it's going to be subject to federal income taxes and state income taxes. So that's the concept when we show that bucket. There's no mercy. I mean, certain assets, if my mom passed away and she has some stock and then she worked for Caloric, which would change to Raytheon, if she passes away, that stock will get a step up in basis. So I can inherit that stock and I'll pay no tax. So remember, certain assets are treated favorably. IRAs are not. They just kind of whack right down the road on all the taxes. It's your responsibility to know. No one's going to come out and tell you. But here's the thing. If you don't know, what questions do you ask? And how do you know you're getting the right answers? Oh, yeah, don't worry. We take care of that. You'll hear from your broker or your advisor and find out that that's what he told me. It's all taken care of. What I did is I created a chart, 6 questions, and you have a copy in your handout. It's really straightforward. If you're looking at having an IRA, if you have a few dollars in there, and it could possibly be worth $1.5 million or more to my family, I want to make sure that it gets, whatever needs to get done, gets done. I want to make sure this family gets the money. So what you're going to look at is something straightforward. Number one, you're going to ask the question, do you offer a multi-generational, or it's sometimes called a stretch IRA, they use the term interchangeably, to non-spouses? Very important. The answers to that question should be yes. Do you accept, or will you accept my specialized beneficiary form on my retirement asset will? Will you accept it? And give me a copy. They'll say, oh, sure, give me it. You send it to them, and that's the last you heard of it. You got to get it back, and it's got to be signed. Very important. Number 3, will you administer and fulfill all the IRS requirements? Now, over the lifetime of my children or grandchildren or other beneficiaries, because the IRS is going to really look at that IRA until there's nothing left in it. So technically, if you left that money to grandchildren, these grandchildren could possibly collect, or even children could collect on that money until they're 85 years old. So chances are that is a long term that the administrator has to look and manage that money. So you want to ask that question. The answer to that should be yes. If your advice is incorrect, untimely, or otherwise faulty, will you make me and my beneficiaries whole? It's really simple. Hey, look, you're the professionals. You're getting the fee for managing my money. I'm coming to you for advice. If you give me advice and it's wrong, are you going to make me whole? Now, that answer has to be yes. If the answer is no, if any of these answers are no, you're moving your money. But that's very important, because one of my people that came to a seminar said he had a financial advisor. He asked him some questions about Social Security claiming. The advisor said, well, let me go to our company specialist. The company specialist said to him, no, this particular rule does not apply to you. And he didn't do something that he had to do by this past June or this past May. So he lost the benefit to file and suspend, which we talked about in the Social Security program. Now, he lost a little over $100,000. And, sorry, it's not our problem. We made a mistake or whatever, even if they admit it. So you want to make sure they basically make you whole. And also, will you make good for any losses incurred, including penalties, any loss of tax deferral, and lost interest. So if this IRA is lost and there's huge taxes due, and you wound up, wow, I lost $400,000 of interest on that money, are you going to make me whole? The concept is simple. You want to make sure, saying, look, if you're going to give me advice, is your advice any good? Or you're just blowing smoke, or you're just saying yes because you don't want the account to go to some other place that will answer yes to these things. So this is very important. Again, you want them to sign that. You want them to have the custodian of the company, as well as if you want to sign it and date it. That's the end of video 3. Let's do a quick review. Okay, let's review. We talked about the true meaning of an IRA, which is fairly supposed to be funny. The 3 taxes while you're alive, delaying while you're alive, and after you're gone. The 5 methods, the Roth conversion, strategic IRA rollout, IRA tax rescue, IRA arbitrage, and charitable planning. We reviewed the Roth IRA and changing from a high tax to a no tax or a lot lower tax. And that's to do with those the red bucket and the green bucket. We talked about the tax benefits of a Roth IRA, the little story about taxing the seed versus taxing the crop, the 7-letter word for sound financial planning. We talked about the stretch IRA and its importance, and why 98% or most are not set up properly. The 4 items that you need inside your retirement asset will or specialized beneficiary form. We went over a quick quiz, why most advisors fail, and how to protect your money with those 6-question chart. And most importantly, I don't want to forget, the QLAC and how that really can help making sure that you have enough money at an older age, as well as giving you a lot of benefits with the low RMDs and the taxes and so forth.
Hi, I'm excited. You're now done with part 3 in your video series. You're making progress. As you progress a little further, I may ask you to help co-author some of my next books because of all the experience you're getting. Again, take advantage if you can or have questions of the Q&A, which is very important. Keep reviewing if you have to any of your handouts, as well as you can always back up and replay some of the sections. So looking forward to seeing you at the end of section 4. Thank you very much.